Hey everyone, welcome to Tax Tip Tuesday, Shey's Way. Hope everybody's having a great week. I see some names here. I'm not sure where everyone's geographically, but let me just start today with throwing out a couple different things. First of all, anyone who is living in the Texas area or some of those other states that are having some serious heat issues. Hopefully everybody's doing okay. And if you have extended family in those areas, then send out some prayers and all that good stuff, because that's no fun. There's some serious problems going on in the country right now with heat. I apologize for not being with you guys last week. Speaking of weather, I know there's a couple of us here that are in Florida, and obviously you guys know I'm in Gainesville, Florida, where last week we had about 7 or 8 days straight of just unbelievable, really bad rain, bad weather, bad lightning. We are clearly the lightning capital of the world. There's no doubt about that. From a sports fan standpoint, we're down here in Gainesville, Florida, licking our wounds from that just thrashing that the LSU Tigers put on us yesterday in the Men's College World Series. If you're not a baseball person, which I'm not a huge baseball person, but obviously my Gators were involved. So I tuned in. I'm going off my sticky note on a couple things that I just want to talk about today. Hopefully we can do a little bit of impromptu. And I just saw a gentleman join. Yeah, so just congratulations out there, David, to your LSU Tigers and the whipping they put on my Florida Gators yesterday. So I'll just throw that one-on-one to you there, because I'm sure that you were watching. You're more of a baseball guy than I am, but wow, what a series. Just a swing in regards to performances. Just unbelievable. Again, guys, the chat is working. If you have, you're welcome, David. If you have any Q&A, hopefully today can be a little bit back and forth with some Q&A, kind of an ask me anything. I mean, I've got some stuff that I want to cover, but certainly want to field any questions that you guys have. I keep going back and forth with watching people make different decisions or maybe not make decisions and just question that. So I'm hoping I can help on some different areas also. From a parenting standpoint, for crying out loud, I don't know if anyone's been watching the news on seeing the tourist that is carving their initials into the Rome Colosseum, for crying out loud. I think most of us are parents. Hopefully we raise our kids a little bit better than that. So that was an interesting news line, I guess, today. Welcome everyone to this week's episode of Shey's Way. We're certainly going to talk about the protection component, investment component, and tax component of your overall financial plan. Talk a little bit about different strategies. We're always going to lay out the truth, the facts, and what we believe regarding the conventional wisdom of whatever you want to call it: retirement planning, legacy planning, estate planning, family planning, just any type of planning that the conventional wisdom still continues to say, defer paying your taxes today so you can pay them later on in life, when we believe taxes will be higher later on down the road than they are today. So certainly willing to get pressed and press anyone that has different ideas regarding that topic. So, the material that I'm sharing today in today's webinar has been prepared for informational purposes only. It is not intended to provide you tax, legal, accounting, or investment advice. You should consult your own tax, investment, insurance, or accounting advisors before engaging in any type of transactions, but I'm certainly happy to give you my opinion. And either today, or if you want to get together one-on-one, then I'm certainly happy to do that also. So there's my disclosure of the day. So with all of that said, again, happy to look at the chat. I also have the Q&A open. So if there's something that you want to throw into the Q&A, then that's fine also. And before I jump in with anything else, let me look at a chat here that I think it just came directly to me. It says, I want to find out more info on lifetime income annuities and their nuances to see if it might be a fit for me in the future. And I know this individual, so certainly I'll hit the high notes today on that for you. And then if you want to get together one-on-one, we can kind of I'll roll the sleeves up a little bit and give you a little bit more details. With all of that said, let me make mention of this so I don't forget, but next Tuesday is July 4th. The whole country is going to be celebrating that holiday. So we're going to postpone next Tuesday's webinar. So no webinar on July 4th. And then we'll be back together that following week. So I just wanted to mention that also. On a personal note, if anyone out there has any experience on sending their kids off to camp, my 12-year-old, who's my youngest, left 2 days ago for a 7-week all boys camp in Maine. And we're trying to figure out, my wife and I are trying to figure out who's going to miss them more. So we're going through withdrawals already after 48 hours, and it's a 7-week camp. I think we get to talk to them 3 times on the phone. So I'm happy to get any advice on that from anyone out there. And that was my sticky note of things that I wanted just to throw out there for anyone that wants to talk a little bit about any of that stuff. So with that said, I want to just share a little bit today regarding anyone's thoughts out there that are, on the economy, on the inflation. We're all going to the store and we're all living the lives that we're living and whatnot. And, I know that most of the people that I'm meeting with, it's a little bit doom and gloom, and nothing's going real well in the country, or everything's costing more than it ever has. And inflation continues to drive upwards, if you will. And I talk to people every day regarding where you're putting your money. There's certainly tax and inflation vehicles out there that will protect the downside risk and possibly pick up a little bit of upside potential. You've got to look at everything. I'm going to say this again because you guys have heard me say it 1,000 times. It is protection, investment, and taxes. Someone may send me their tax returns, and my team will scour those returns to find the savings to allow someone to go out and either invest in alternative investments, multifamily syndicated housing. I don't want to use the word invest in a life insurance policy, because I view insurance contracts as a protection component of your overall plan, not an investment component of your overall plan. And let me hit that real quick. When somebody calls me up and says, hey, I've heard insurance is a bad investment. Here's my boilerplate response. I completely agree with you, because insurance is not an investment. Insurance is protection against your investments not working out. And I say that because most of the time, people want to talk about the interest rate or the dividend rate or the dividend scale inside of a life insurance policy or whatever it may be, and then they'll want to compare it against an investment. I'm going to say it again. Insurance is not an investment. It's insurance against your investments not working out. So, we talk a lot about the tax-free shelter of how life insurance works and how money grows inside life insurance and everything else. But when you start looking at your overall portfolio of allocation, you're going to have money in areas that you're looking at getting 8, 10, 12, 15, 20, 30% rates of return. And those are not conservative investments. Those bear risk. They are much more riskier than a bond portfolio. So that's when I talk about, if you're going to use, which I highly recommend, using some type of permanent life insurance inside your overall portfolio allocation. And it should be the conservative part, where if your investments are not working out, or one just takes a beating or whatever it may be, your insurance policies are the protection component that, again, are going to protect against your investments not working out. So, and there's different areas of those types of policies that protect your downside risk, but allow you to have upside potential. So, I want to say that. And I also wanted to mention, because there's a number of cases that I'm working on where not every product is made the same. most of the planning that I do for people is they are not going to continue to fund their insurance policies into their 60s, 70s, 80s, 90s, and later on in life. They're going to fund them for a period of time and then allow those policies to continue to grow so they don't have to continue funding them. I'm going to kind of get off that soapbox, and if there's some questions regarding that, that's perfectly fine, and we can cover that. The other side of that, the other thing I wanted to mention regarding the protection component is, I don't know where everyone lives, but obviously here in the state of Florida, something that we haven't talked a lot about on this show is the property and casualty insurance policies. Your auto, your home, your commercial lines, your umbrella policy. Most of the people that are on this webinar have some type of real estate portfolio holdings. And all of those other insurance policies, obviously there's a cost to them. And that is something that we look at regarding the tax returns, where your money's being spent, find savings in your tax area where you can continue to fund those other types of policies. And I'm bringing it up because here in the state of Florida, that is a dangerous industry right now. There's a tremendous amount of carriers out there in the property and casualty insurance arena that don't want to play ball in the state of Florida anymore. They don't want new policies written, whether it be on auto or home or commercial lines or workers' comp or any of that stuff. And that's an area that is concerning. And it may be affecting you in your state, maybe not. But I do know that the other part of that, where the carriers are not only not wanting to write, if they are writing policies or they are renewing policies, they're renewing them, at probably the low end of 20% increases up to 30 and 40% increases. So again, that's an area where I look at every dollar and where those dollars are being spent, and can they be spent at a lower rate, if you will. So that's just another area that, that if you're not thinking about, I know that in my personal life, that's probably north of $50,000 a year that is going out of my budget to some insurance carrier for some policy to protect me and protect me against my downside risk. So again, just wanted to share that a little bit. Let me get over to the one question that came in. Find out more about lifetime income annuities and their nuances to see if it might be a fit for a person in the future. First of all, I'm not a huge advocate of using annuities for younger people. I've always find it a little bit mind-boggling when someone comes in and tells me that they have an annuity that they've been funding and maybe they're in their late 30s and early 40s. That to me just really never made a whole lot of sense. When here's a nuance, there's normally a large surrender period in annuities where if you want out in years maybe 1 through 10, 1 through 11, 1 through 13, the insurance carrier is going to charge you a surrender fee to get your money back out. So that's never been something that I felt was in the client's best interest to have to pay to get money back out of some type of contract. An annuity is an insurance contract, by the way. Annuities are created by insurance carriers. So I'm not a huge fan of long surrender charges. Number two, you can certainly find lifetime income annuities that are, 4 or 5, maybe 6% on a guaranteed rate when you start annuitizing or taking the money back out of that product. That's a conservative rate of return, in my humble opinion, and therefore you're going to want assets somewhere else that are growing a little bit better than that. Lifetime income annuity, like the product states, it's a lifetime source or lifetime stream of income. There are a number of people that I work with that we have laddered their annuities over time, where maybe you do a 5-year, maybe you do a 10-year, maybe you do a 15, maybe you do a 20. So you can ladder annuities over your retirement ages and get different interest rates and different guaranteed rates that are going to pay out for a period of time. If you're willing to lock your money up longer, the insurance carrier is normally going to give you a little bit better rate on your money. But again, they are individualized, if you will, and you certainly want to look at different carriers. Again, I'm going to throw this out there right now. If there's anything going on, product related, individually related, economically related today, good time to just throw a question into the chat or the Q&A, and we can talk a little bit about that. From an economic standpoint, I'll just say, here we are at July. So I'm still bearish on the economy right now regarding not only this year, but next year with the election year coming. I think it's a good time to continue to be bearish regarding the market and the economy as a whole, maybe not individually. The other side of it is, at least here in Florida and from what I've heard in multiple other states, I would be very bearish on commercial property, office buildings, stuff like that. That's a dark hole right now, I think, in most of the state. Regarding tax, if you are not using, most of the people on here have corporations. So if you're not using just the small, simple tax strategies in regards to hiring kids, hiring grandchildren, and using your tax-free rent. Let me hit the tax-free rent piece, because that's something that I'm not sure why more people don't use it. And then there's been some confusing questions about it. But from a tax-free rent standpoint, and I think it's IRS code 259A, maybe 250A, that says any particular person can rent out their home for business purposes 14 times a year. And the way that you want to do that, if you do it on your own, or if you use your CPA, is whatever area of the country that you're living in, do a low, medium, and high. So contact some type of hotel and ask them what their rate is for you to rent a conference room. Then take the average. And for conversation purposes, you might find an 800, 1,000, and a 1,200. So you say, okay, well, $1,000 is the medium range to go rent a conference room at a hotel. Therefore, at home, you can rent your house out to have that business meeting 14 times a year at that rate, at that $1,000 rate. And by doing the research, basically your CYA, and if the IRS were to audit you, for you to figure out, or for you to explain to them how you got that number. So if it's $1,000, then you can invoice, your business can invoice you personally for that $1,000 14 times a year. And this is a good one because you get the double dip. Your business obviously is a $14,000 expense, but then you can pick that $14,000 worth of income up, and it's a small amount, but it's non-reportable. Or non-taxable, if you will. You still do report it on a form when you do your return, and your CPA can certainly handle that for you, but it just offsets the income and the expense, and it's an expense to the company, and you don't have to pick it up as income. And then in addition to that, if you're not paying the kids or putting them on payroll, that's just another area where you can recoup, depending on how many kids you have, that type of money, you can recoup that back into your income and your budget without having to pay the taxes on that. Nothing illegal there. It's certainly within the IRS code that you can do this. And for the most part, most of the clients that I work with are doing these, but the tax-free rent is one that I've run across where people just haven't been doing it or didn't know about it. So just wanted to mention it. Again, any questions on any of that, throw it into the Q&A or the chat, and we'll cover it. I threw out there my email at sterlingwhite.com. Again, for any follow-up questions, you guys can send to that email address that is monitored all the time. And I'm sorry, I said email, I meant my website, sterlingwhite.com. So Again, feel free to reach out with any specific questions or again, throw them in there. Let me go back to my sticky note here for a minute. Real quick, I did want to mention, obviously, we weren't together a couple weeks ago. I was down out of the country, let's just say. And I was actually out of the country on a business trip with One America. And I wanted to mention for anyone out there, obviously, I'm a big proponent of that insurance carrier, almost use them exclusively regarding any kind of life. Certainly the asset-based long-term care strategy that company pioneered and invented over 30 years ago. If you are anywhere near the age of 50 or above and have not transferred the risk of some type of catastrophic long-term care health issue, that is something that you should reach out to me and at least have a conversation or a cup of coffee along those lines to see if that is a good fit for you. In my humble opinion, One America is the only carrier in the country that I would even use regarding that type of strategy. They are the only company left that pays a lifetime benefit for a husband and a wife. It's one contract that covers both of you. They're the only company that you can use qualified money with. So that is, again, I'd say if you're anywhere close to the age of 50 or above, or have parents that are in that age, obviously, that's a conversation we should at least have. Wanted to mention One America because if you're looking at their financial report, you're going to see that, again, I'm not the chief financial officer of One America, nor am I an economist, but what you'll find is that One America wrote off and will show a loss in regards to their financial report. And they had an opportunity to relieve a tremendous amount of, let's just say, long-term debt and pick up some reinsurance in that area. It was a phenomenal investment move, but when you look at it on the balance sheet, it says something different. So I just want to mention that for the people out there that are working with that company and may roll up their sleeves and get into the financial report of the company as a whole. So we can talk a little bit about that if there's somebody out there that wants to talk about that one-on-one. With that said, that's about my sticky note of points of conversation of the day. Again, I'm going to keep licking my wounds on the Florida Gator baseball loss from last night. That was that one hurt. David, again, congratulations there to you guys. So it was a great series, and LSU is just they've put their dart on the map for sure with that area. Mark, hope I answered a little bit of your question on lifetime income annuity, and happy to I'll send you some personal information on two different companies that I would use. One of them happens to be One America, but there is one other one that I would use in the annuity area also. Okay, so I've got a question regarding when I mention alternative investment or multifamily alternative investing. What do I mean by that? What I mean by that is one of the areas that is probably opposite of commercial space or office building space in the country right now is the use of alternative investments with multifamily. If you haven't been around the colleges still have a ton of money, and they're continuing to build apartment complexes all over the college campuses, just about everywhere in the country. That's multifamily investing, and you have the opportunity to invest in those projects, earn a limited liability rate or a general partnership rate, and then that is an invest hold for, sometimes it's a hold for 2 years, sometimes 3, sometimes 5 years. But normally the IRR in those type of investments for this person that's asking it is somewhere around 18 to 20% internal rate of return. There's going to be a guaranteed or a preferred rate paid out on a quarterly basis. And then when the property is sold, normally within 2, 3, or 5 years, then there's really about a two times multiple. So if you're investing 100 grand, plan on getting back 2 plus the rate of return during the investment period. So that's what I mean when I'm talking about multifamily, or alternative syndicated investments. So, and again, I can give you more detailed information on that if you'd like. So, with that said, any other questions, send me an email. Next week is July 4th. So let's postpone and, everybody have a great 4th of July, be safe and all of those good things. With that said, everybody have a great rest of the week. Good being with you. Good seeing some names here that I haven't seen in a while, and won't see you guys next Tuesday, but I'll kind of send out some additional refreshers and points of contact so we get back together here in 2 weeks. So with that, everybody have a great week, and see you in a couple weeks. Happy 4th of July. Bye-bye.